Comprehensive Financial Advice Guide. 1. Budgeting. 1.1. Understand your income and expenses. Track income. Record all sources of income, including salaries and investments. Track expenses. Categorize expenses into fixed, rent, utilities, and variable, groceries, entertainment. Use tools like spreadsheets or budgeting apps to monitor spending. 1.2. Create a budget. 50-30-20. Rule. Allocate 50% of your income to needs, 30% to wants, and 20% to savings and debt repayment. Adjust as needed. Review and adjust your budget monthly to reflect changes in income or expenses. 1.3. Stick to your budget. Use cash envelopes. For variable expenses, use cash envelopes to control spending. Regular reviews. Regularly review your budget to ensure you're staying on track. 2. Saving. 2.1. Emergency fund. Goal. Save 3 to 6 months' worth of living expenses. High-yield savings account. Keep your emergency fund in a high-yield savings account for easy access and better interest rates. 2.2. Short-term savings. Goals. Save for short-term goals like vacations, home repairs, or new gadgets. Separate accounts. Use separate savings accounts for different goals to track progress more easily. 2.3. Long-term savings. Retirement. Contribute regularly to retirement accounts like 401ks or IRAs. Investments. Consider investing in stocks, bonds, or real estate for long-term growth. 3. Investing. 3.1. Understand investment options. Stocks. Ownership in a company. Potential for high returns but higher risk. Bonds. Loans to companies or governments. Lower risk but lower returns. Mutual funds, ETFs. Diversified investment in multiple stocks or bonds. Managed by professionals. Real estate. Property investment. Can provide rental income and appreciation. 3.2. Diversify your portfolio. Spread risk. Invest in a mix of assets to reduce risk. Rebalance. Regularly review and adjust your portfolio to maintain your desired asset allocation. 3.3. Long-term perspective. Avoid market timing. Focus on long-term growth rather than short-term gains. Stay informed. Keep up with market trends and economic news, but avoid making impulsive decisions based on short-term market fluctuations. 4. Managing debt. 4.1. Types of debt. Good debt. Mortgages, student loans, investments in your future. Bad debt. High-interest credit cards, personal loans for non-essential items. 4.2. Strategies for paying off debt. Debt. Snowball. Pay off the smallest debts first to build momentum. Debt avalanche. Focus on paying off the highest interest rate debts first to save on interest. 4.3. Consolidate and refinance. Consolidation. Combine multiple debts into one to simplify payments. Refinancing. Lower interest rates through refinancing options for mortgages, auto loans, and student loans. 5. Retirement planning. 5.1. Start early. Compound interest. The earlier you start, the more you benefit from compound interest. Consistent contributions. Regularly contribute to retirement accounts. 5.2. Retirement accounts. 401k. Employer-sponsored retirement plan. Contribute enough to get the employer match. IRA. Individual retirement account. Choose between traditional, tax-deferred, or Roth, tax-free withdrawals. 5.3. Estimate retirement needs. Retirement calculator. Use online tools to estimate how much you need to save. Adjust goals. Regularly review and adjust your retirement savings goals based on changes in income, expenses, and life circumstances. 6. Insurance. 6.1. Health insurance. Coverage. Ensure you have adequate health insurance coverage to protect against high medical costs. Employer plans. Take advantage of employer-provided health insurance plans. 6.2. Life insurance. Term, life insurance. Provides coverage for a specific period, lower premiums. Whole life insurance provides lifelong coverage and builds cash value. Higher premiums. 6.3. Other types of insurance. Disability insurance. Protects your income in case of disability. Homeowners, renters. Insurance. Protects your property and belongings. Auto insurance. Mandatory coverage for vehicle-related damages and liabilities. 7. Tax planning. 7.1. Understand tax obligations. Federal and state taxes. Know your tax brackets and obligations. Self-employment taxes. Plan for additional taxes if you are self-employed. 7.2. Tax-advantaged accounts. Retirement accounts. Contribute to 401ks and IRAs for tax benefits. Health savings accounts. HSAs. Save for medical expenses with tax advantages. 7.3. Tax deductions and credits. Deductions. Mortgage interest, charitable contributions, and education expenses. Credits. Earned income tax credit, EITC, child tax credit, and education credits. Conclusion. Effective financial management requires discipline, planning, and regular review. By budgeting, saving, investing wisely, managing debt, and planning for the future, you can achieve financial stability and work towards your long-term financial goals. Stay informed, seek professional advice when needed, and continuously educate yourself to make sound financial decisions.